Okay, let's get going. So good morning, everybody. I wish I could see you all. It's been a long time since we managed to connect. I know that we've tried to stay in touch the best we can via email. We've been providing you with our thoughts along the way through a series of GTA restructuring communications. And our opinions are what they are. Not all of them have come necessarily true, but we've been pretty accurate in a bunch of them. We'll share a little bit more about that as we go through. So thank you for taking the time to join my partner, Steve Kaiser, and I to provide you with a state of the market. We do get requests on a daily basis via email and telephone call to chat about what's going on. So we found that creating a platform like this, which we did 5 years ago, allowed us to go ahead and address the key items that we get asked about the most. So we're going to take you through that today. Largely, this will be focused around mixed use and multifamily. There's a chat button at the bottom center of your screen. I can't see it, but you can, hopefully, that allows you to submit questions, which we intend on answering. If we don't get to them for whatever reason, we will respond to them all via email. So please submit them and we'll come back to you. Steve, can we move on to the next slide, please?
Yep.
Okay. Steve will be driving the bus for both of us today, if that's okay. So we'll give you an introduction as to who we are. So my name is Ian Gratman. I've been at this for a little while, a little over 30 years. My partner Steve has been at it for about 15, and we co-manage the Toronto Urban Redevelopment Advisory. So when you saw that acronym TURA, that's what this reflects on, or that's what that represents. And so the TURA Talks was a take on the TED Talks that most of you, if not all, have been familiar with over time online. So based in Toronto, we lead the redevelopment vertical for Colliers and also run point on the newly developed this year insolvency, bankruptcy, and restructuring activities. Much of our success, an enormous amount of it, including this morning's presentation, is made possible in large part by our partners, Tina Tang and Sylvia Laban. Tina and Sylvia, I know that you're listening and I know you're online. We're super grateful for who you are, certainly your intellect and everything you do. So thank you for that. Steve? So our activities largely focus on the maximization of value on a given asset or assets. And so whether you're in the mixed use, multifamily, industrial, office, or retail vertical, or if any of your assets relate to that, the items you're seeing on your screen now tend to come into play in one way, shape, or form. So in order for us to maximize value, it's important that somebody is versed in all of these components, and we are. Not for a moment do we suggest that we're an expert in environmental, but we understand enough about it. If you look towards the phrase a mile wide and an inch deep, on some of these components we're an inch deep, and a lot of them were a lot deeper than that. But you need to be able to sew all these things together to be able to maximize value and minimize risk, and that's what we do. So Steve, on to the next slide, please. I'm going to pass this over to Steve Kaiser. He's going to get into the land overview, construction, municipal changes, high, medium, and low density housing, and then the rental market, and then I'll come back and share some other thoughts with you. Steve?
Thanks, Ian. We have a lot of content to cover. I know a lot of you are looking for deal talk, but majority of what I'm going to discuss today is relative new policy that's happening in amongst all of the COVID hysteria, let's call it. There's a lot of planning changes underway and a lot of, as we say, gain your competitive advantage and your competitive edge. There's lots of opportunities being created through new legislation, which we'll take you through. So just to start on the high level stats, because I know people love deal stats. This is a look at the first 3 quarters on a year-over-year basis. This is total volume of transactions throughout the GTA for residential land. So as you see in Q1, obviously nothing was really affected from previous transactions that were likely contemplated in 2019 coming into 2020. We did see quite a dip in Q2, and then a recovery in Q3. Now, I don't like typically to use, for our vertical, these stats because the transactions that we contemplate, and you all know this, they take 6 to 12 months in terms of conception to due diligence to possible closing, and some even longer. So although we're giving you a snapshot of the current and past 3 quarters, we think that the outfall from the current economic downturn is still 6 to 12 months away. So we're going to continue to update you on these stats. But for the time being, on a year-to-date basis, we're down 18% on all transactions, being high-rise, mid-rise, and low-rise. And then just to break that down a little bit further, in terms of high density, medium density, low density, here are the stats. So you'll see for high density at the beginning of the year, high transaction volume of high density. And then when you look at medium and low density, you'll see that relatively it picked up quite a bit in Q3 in this last quarter. Now, can some of that be attributed to the fact that right now a lot of people are looking to get out of condos? And I stress that that's a short-term thing, short-term knee-jerk reaction to the pandemic, that medium and low density transactions have actually gone up this quarter because there is an uptick in terms of the developers that we talk to, in the 905 and outside of the city, that there is an uptick on low-rise sales, where in the previous kind of 8 quarters, it was really hampered by the stress test and affordability. And it's picking up now as people look to get out of condos. And, personally, I know a lot of friends that have moved outside of the city. I think that's very short-term thinking, but we'll save that discussion for another day. But you're really seeing a pickup relatively in Q3 on low and mid-rise density for obvious reasons. So on to construction pricing, and this has been a hot button item for now a couple years as pricing has escalated quite significantly. And this is from our friends at Altus. So this gives you a breakdown right now from ground up all the way up to developers' profit, the percentage of the overall gross revenue over project and cost. So, developers' profits really haven't changed in the last 10 years, let's call it. Government charges, however, have increased significantly, and we'll get into some of the changes with regards to CBCs coming up. Soft costs obviously increase as well as hard costs. We all know that in terms of concrete and other raw materials coming in the current lag in production in back ordering of products, and that's exacerbated that. And land value typically around 15 to 30% on average of a particular project. So that's the current numbers. Obviously, these always change. Now, to break down the escalation in terms of construction pricing, at the beginning of this year, Canada-wide, building construction costs rose 0.5%. And however, new construction projects and building permits fell 17% in March and April, and a record 14.2% decline in single-family dwellings. Now, that's obviously a direct reaction to the pandemic. However, as I said, labor and materials demand increased following the shutdown period, and market uncertainty coupled with supply chain disruptions are going to require ongoing adjustment in terms of construction costs. So you'll see that the escalation from 2017 to 2019, roughly 21 to 26% on aggregate, where on average previous 0.75% to 1% escalation on a quarterly basis. So that hyper escalation, kind of peaked last year, and now there's been somewhat of a reset with the current challenges, both on an on-site basis with labor and additional costs associated with PPE and hand washing stations and all the protocols, and the efficiency overall of work on site. So as we get into, so I'm just going to go back there, just focusing in on 2020. Immediate pricing on site went up, again, due to the protocol of on-site PPE. And But overall, other pricing we're seeing from talking with developers in terms of concrete and forming, mechanical costs, everything's still coming in on pro forma. Just with the maybe some time delays on deliveries in terms of raw materials. And extended working hours have been a godsend. If that didn't happen, these inefficiencies would have definitely eaten into projects in terms of overall construction timeline quite significantly. But the fact that your working hours, day working hours are expanded, that's saved a lot of pro formas on projects currently under construction. So as we look into the medium term, there's varying opinions on this, but there are going to be projects that get shelved over the next few months, and it's expected that cost should level off or potentially decrease at the end of this year into next year. So I know a lot of developers on this call are hoping that's the case, just with the lack of demand, and in terms of the labor market, we're seeing a lot of construction job losses in the first couple quarters, or sorry, second and third quarters this year. So the city of Toronto, though, obviously relies on development applications and fees. So I think the city is going to want these developments to move ahead and fast tracking development applications, and hopefully that brings back a lot of the demand side for construction. So moving on, municipal changes. So there's a lot of content here. If this were the Oscars, we'd probably be a couple hours over with long speeches. So I'll try and be succinct as possible. But this is very important to our industry in terms of what's happening. And I know a lot of people on this call can get into deals and the policy side of our business. You can fall a little bit behind on, but because things have been so active, we wanted to make sure that everyone was up to speed. So Bill 108 obviously came out last year. Receiver wrote us in June. Amendment to the LPAC Act. It amended 13 different statutes that impact municipalities. And so the LPAC Act, this is to address the backlog of cases that has tied up about 100,000 units. This is kind of old news, but just to bring everyone up to speed. 100,000 units in Toronto alone, and to manage ongoing and future caseload. That was Bill 108. So we all know that LPAT was restored mostly to its previous state, introducing new evidence. That's now allowed, permitted again, cross-examination permitted again, and non-parties may only make written submissions. The reduced timelines for filing appeals, as outlined, potential for increased appeal fees as well, and transition to the rules are to be announced, and that's subsequently been announced as part of Bill 197. So development permit system. So this is an amendment to the existing development permit system regulations of 2017. So basically, it requires municipality to implement a development permit system in a specific geographic area. Well, what's a development permit system? This is basically a process, online process for speeding up development permits in a bunch of different areas, such as major transit station areas and provincially significant employment zones. So fast tracking development around provincial spending on transit is a priority for the provincial government. And this is all within a specific time frame to be able to get your development permits. And so another thing that came about it was only the minister can appeal official plan policies or bylaws implementing a provincially mandated development permit system. So that's very important as well. So that's going to speed up your permits and get them around the existing system that obviously everyone knows there's delays associated with it. So fast tracking developments, it's a theme for this government. Inclusionary zoning. So this is a very hot button item, and speaking with many developers, this is huge, but it's coming. It's in other cities. It just hasn't been as defined typically in the city of Toronto. So in September, so again, this is very recent, City Council adopted a proposed official plan amendment to the city's affordable mid-range rent definitions and endorsed inclusionary zoning. And so it's going to conduct further analysis to achieve a range of 10 to 30% of residential GFA for new condominium developments as affordable, and 5 to 20% of residential gross floor area of new purpose-built rental developments as affordable. And so what didn't work previously was when you look at average market rents, AMR, as the term is typically referred to, AMR rents, the city defined affordable as spending 30% of your income on rent. But with AMR rents as they were set, only 20% of those that needed it actually paid rent below 30% of their income. So the changes that are going to come are going to be based on income. So not based on AMR, but rents are going to be geared to income. So that means that that AMR number is not going to be followed for the most part, except for those that qualify and have an income to qualify for that AMR level. And then mid-range rents, which are typically used for replacements, there's going to be 2 mid-range rent bands, so which will maintain the city's ability to replace existing units at similar rents, so that rents aren't jacked up when rental replacement is happening on a site. So that's those are a couple of big items that we're waiting further announcements on in terms of that percentage, how it's calculated, the percentage of inclusionary zoning on projects. So that's a big one coming down the pipeline that everyone needs to factor in. Ontario Heritage Act, the quick one here is that LPAT previously did not have the authority over heritage appeals. Now they do. So they'll be able to for appeals for designated bylaw, appeals for to repeal a designation, and appeals on applications to alter or demolish heritage buildings or structures or attributes. So now you can go to LPAT with that, but the Heritage Conservation District provisions do remain unchanged. Development Charges Act. This is a big one for Bill 108, which is now further defined in Bill 197. So CBCs, the government did a long period of surveying the public and talking to industry about how this calculation is going to be changed. And so the permit, so CBCs basically allowing development charges for rental housing and nonprofit housing to be paid over a 5-year period. So there's a deferral mechanism there now in terms of building rental. And so CBCs are to replace soft services of development charges. So a lot of the servicing such as police, fire, other city services, as well as Section 37 contributions and parkland dedication. CBCs are to replace all of those. Hard services were still to be separate. So municipalities must prepare a CBC strategy in accordance with these regulations before enacting the CBC bylaw, and there's no right to appeal the CBC bylaw. So that was an announcement that came out earlier this year, maybe late last year. And then Bill 197 further defined this. So there was a lot of discussion around what that percentage cap was going to be. You see in the top left, this is the way that it used to be in terms of calculating your development charges, your Section 37, your parkland, and those could be up to 35% or greater of your land value in some cases. Bill 108, as you see in the bottom left corner, packaged it as I just mentioned, and there was discussion around that being capped at 15% plus hard services. If you think of hard services as infrastructure, so everything road related, sewers, hard construction costs for municipal projects. Bill 197, if you look over on the right, what is getting finalized is actually a 4% cap on soft services, parkland, and Section 37. So relative to what we thought was going to be 15%, it's now capped at 4% for those 3 items, still with hard services added on. So when you look at development charges, just to give you an idea of the ratio existing, about 65.5% were soft services historically, and 34.5% were hard services. So that can give you an idea of what that plus DC hard services will consist of. So as of September 18th of last month, municipalities will now have 2 years to transition to the CBC charges. Up until then, they can continue with the existing program. So it won't be implemented, and I'm sure the City of Toronto will not want to implement it until that very last date, because of course there's a lot of revenue to grab for them up until that point. Of course, CBCs will only apply to higher density residential buildings with 10 plus units or 5 plus stories, with exceptions for certain asset classes like long-term care, universities, etc., institutional. So the community, sorry for a second, community planning permit system. So it's a framework that combines and replaces individual zoning, site plan, and minor variance process. So similar to the development permit system, the community planning permit system is meant to speed up individual site zoning, site plan, and minor variance processes. So this is going to be something, again, that will hopefully take out the backlog at the City of Toronto when you're doing, things such as minor variances and you're all into the same kind of wait times as everyone else. This is meant to fast track that so that permits can get pulled quicker within the City of Toronto. Building code. Bill 197 will enable faster changes to the building code so the province is ready to act quickly to advance necessary recovery-related changes and harmonize with the national construction codes. So this also allows for innovation. So the ability for the building code to change quicker will allow for innovation. If you think of some things such as timber frame construction in other cities, some buildings are 15 plus stories. Currently, you're allowed to build 6 stories, stick build. So these building code changes will harmonize and become a little bit more modern and allow for more innovation. Enhanced Minister's Zoning Order. So this is something that's very important. So currently, with Bill 197, the Municipal Affairs and Housing has enhanced authority when zoning land outside of the Greenbelt. So the minister could currently make zoning orders regulating the land use of land, location, height, size, and spacing of buildings and structures. But they can now address site plan matters. They couldn't before, but they can now address site plan matters. So that, again, is meant to get it out of the city's hands and to allow fast tracking of certain projects that may be important to the city even, where they're caught in their own processes. So something whereby it's a very large project for employment. There's some examples of that previously where recently the government has issued an MZO and it's around major employment. So it allows for fast tracking that. It makes the province and our city more competitive in terms of attracting industry and distribution centers and other employment, as well as housing. Environmental Assessment Act is outdated. And so the goal, it's over 50 years old, the current Environmental Assessments Act. And for some projects, comprehensive environmental assessments takes over 6 years. For example, planning the new subway lines, long delays in environmental assessments, and things even as simple as installing traffic lights at a corner. Full environmental assessments were needed. But this will allow for, in terms of a degree of risk, of environmental risk, that to be assessed in terms of the environmental assessments to be completed. And so a lot of projects where it was kind of irrelevant for environmental assessments to go that detailed, those will be fast-tracked as a result. Next, Transit-Oriented Communities Act. So this is to enable the province to effectively assemble lands through and around transit-oriented communities. And so it's going to be an exemption from hearings of necessity. And so a lot of you have heard that term terms of expropriation. So there's going to be new commercial arrangement for the province to acquire lands around planned transit stations. Now, what does that mean? Does it mean that the province can just come in and take your land and there's no hearing in terms of what the value of your land is? No, but it's very gray. So we're waiting for further information on this in terms of what the specific process is going to be, but it definitely eliminates the hearing of necessity. So with the planned transit stations, as you see below, these are going to be the focus of these TOC communities, and you'll see the province becoming very active around those sites. So when you look at opportunities for development, obviously being close to the major transit station areas and these areas of provincial investment are going to be beneficial. So growth plans. So they're provincially significant employment zones, and within these, if there's major transit expansion, there's going to be the opportunity to convert some of these lands through municipal comprehensive review or even outside of a municipal comprehensive review for change of use, where previously that was not the case. Places to Grow Act has been updated in terms of forecasts, slightly in terms of population, in terms of going from 13 million to 15 million people, and going from 6 million to 7 million jobs by 2051 in terms of the 2041 and 2051 forecasts. So that has been updated, and densities have been updated, which are going to focus around the major transit station areas. MPAC. So historically, MPAC has been a mess in terms of assessments throughout mostly Toronto. In terms of provincially, if you look on the far right, Ontario assesses properties every 6 years, where provinces like New Brunswick and PEI, they assess them every year. So what's being proposed is that we, Ontario, are going to go to an annual assessment cycle. So that's going to eliminate all of the tax capping, clawbacks, tax banding, phased-in assessments that happen, as well as for properties in transition. It's going to better define the tax bracket for that particular project. So I'll get into that on the next couple slides. So land and transition. So in a lot of our clients' cases, when they're sitting on a site that is maybe a future development piece of land, they're taxed at that valuation. So the Assessment Act basically historically has been at the current value. So if the property is to sell at arm's length to a buyer, what is the tax rate? So this is created value misassessment in terms of if there's an existing retailer on site and the site hasn't actually traded at market value. A lot of small businesses have been impacted significantly by a huge increase in taxes, and we've all seen it and heard from it in the media. So basically, the province is looking to equalize and make a better platform for assessing these properties in transition based on their current use rather than their future use. In terms of multi-residential, so multi-residential tax rates have gone up significantly as well, and there's large inequities in that valuation. So in 2017, the province enacted a new multi-residential act, which was supposed to equalize taxes for multi-residential and residential properties. So occupants of new multi-residential are taxed at the same, basically, as a single-family home. So the multi-residential act, it didn't fully suffice because there continued to be additional tax as these properties were deemed commercial. And so this year, it was identified that in several municipalities, multi-residential is paying up to 2 times the tax rate of a single-family home. So it places an unfair tax burden on those renters. as individually there are residential rental units, and it increased to an increase in cost of housing. So that is going to change, as well as the valuation of commercial and industrial. Currently, as many of you know, commercial properties incur more than 2 to 3 times the taxes that an equally valued residential property incurs. So that tax differentiation creates an imbalance between the municipality and other provinces, which creates a dramatic negative impact on Ontario business, with commercial property rates being very high. So despite the longstanding policies to reduce the gap, it remains large and progress is slowed. So the province is seeking measures to compress that gap to make Ontario more competitive. So we'll likely see a reduction in commercial property tax rates, which is great for landlords and great for overall for the economy on a competitive perspective. That's the legislation. So I know it's a lot to take in. We have a lot of notes on this and a lot of research. So even though we're skimming over it for the most part today, please contact us. As you know, it's a lot of information, a lot to cover, and there's a lot of details associated with all of these changes. So definitely please reach out to us. We have the research, we have the answers for you. Getting back into the stats in terms of high rise, low rise, and mid rise. We just wanted to show you the trend line over the last 24 months of price per buildable square foot. This number has jumped up and down, and a lot of the times there's not a lot of data points to fully analyze this. But the data that we do have and the points that we do have, you'll see that in Q3 2020, the price per buildable square foot is around 128 per buildable for transactions in that quarter. And really the fallout from COVID, we likely won't see for another 6 months in terms of what that's doing to price per buildable square foot. We know that on certain transactions that we're seeing in the market, that there is a roughly 10 to 15% discount on some sites of what the previous deemed value was going to be. But overall, 1.3 billion dollar decrease from 2019 in terms of transactions. And so far 93 transactions this year, a 5% year-over-year decrease. The average parcel size continues to get smaller in terms of acquisitions as the big pieces. That's an ongoing trend that we say every time we present. And then in terms of the breakdown on area code, 85% of high density downtown, which is no surprise, and 15% outside of the 416. This is a trend line on price per buildable square foot over a 12-year trend line. So, continued graduation and an increase of the price per buildable square foot number, although it's bounced around the past 24 months. The trend is up, which again is no surprise, but we just like to track this on a quarterly basis. What's happening in the market in terms of units? So here are the projects that are in the market currently for high density. And a number of you know these projects. A couple launched recently in terms of 55 Mercer in the Entertainment District, Liberty Village, North Market Tower, Untitled. These are projects that are currently still in the market, as well as 88 Queen. And what we're seeing in terms of the launches that have happened is that there's still strength. There were a couple recently with Center Court at 199 Church Street, as well as our Altera at 32 Eastern. Now those projects did get to their minimum sales thresholds, and not as quickly as probably previously, but certainly there's still demand in the market for pre-construction pricing in units. And here's just a shot of the average stats for high density. In terms of medium density, in the first 3 quarters of this year, sales volume is down a bit, and obviously getting now into the 905, as you'll see on the far right. More of these transactions are happening in the 905 in terms of mid-rise. In medium density, A lot of projects downtown along the avenues struggle to find revenue in the face of increased costs, especially on mid-rise projects. And in speaking with a lot of developers, these mid-rise projects really only start to make sense once you hit 10 stories and up. So you have to get really favorable pricing on medium density sites in the downtown core to make a go of it. And pricing expectations don't necessarily always align. In terms of projects and mid-rise projects in the downtown, we're seeing an average price per buildable price per square foot sold of $11.37. There's been a number of project launches during COVID, and there seems to be still strength in that market. Obviously, low-rise and mid-rise buildings are more attractive in this environment. So we're still seeing some healthy numbers on these projects which have launched recently. Low-rise. So obviously, as mentioned at the beginning, low-rise is becoming more popular in this environment. And here is the annual stats, again, for acquisitions. Low-rise is mainly, obviously end user buyers. And so stress test rate has gone down to 3.14%, which is helping in terms of first-time home buyers. It is really driving the increase in sales in low-rise. And I know in the downtown, single-family housing pricing is again going crazy. I'm not just saying that because I'm selling my house soon. There's actually quite a demand right now for low-rise housing in the downtown, and the stress test will help that both downtown and outside the city. First-time home buyer incentive, we touched on this last time. CMHC is administering a program where they will contribute equity into a purchase of a home. So for first-time buyers, and we discussed previously how it really wasn't any numbers that would be associated with the city of Toronto, but certainly it helps outside of Toronto. And so what's been updated on this point is that the repayment of that equity loan is going to be deducted from a sale of that asset at a future date, or it could be paid back on a straight line basis, interest-free, for that equity contribution repayment. So again, that helps. The move outside of the city for certain people that have a certain budget, that helps if you're a first-time buyer. Just quickly going to breeze through the rental market stats in light of the current economic situation. So in terms of rents for condos, we have two sets. We have rental numbers for condos and rental numbers for PBR. So you'll see in Q2 the numbers started to come down in terms of rent per square foot per month, and we're going to continue to track this in terms of the impact in terms of rent. We know that there's a lot of product on the market for rent and for sale in terms of condominiums, but we do expect it to be a rough go over the next 12 months in terms of absorption of condo rentals. You'll see here average unit size continues to go down and hover around just over 700 square foot per unit, which has been trending down generally over the last 5-6 years. And average days on the market, this is obviously very current and important in terms of number of days on the market for condo listings. And so you'll see that number starting to creep up versus the past 4 years as product is sitting on the market for condos. And it's definitely turned to a buyer's market for condos and for renters, albeit in the short term, I believe. And so here's the number of condo lease transactions. And we do have the latest information we do have is Q2. So you'll see there was almost roughly 2,700 less transactions in the second quarter when you compare 2019 to 2020. So that's a significant drop in condo lease transactions. So switching over to PBR, you're seeing for Q2 of this year, a 0.3% decline in average rent, where if you look over the past 6 to 8 quarters, there's been a significant increase. So the current economic climate is reducing the average rent slightly, and we'll obviously continue to monitor this information over the next couple of quarters. Total proposed units continues to go up, ongoing trend, purpose-built rental, 60,000 in the planning pipeline, with another 3,000 new proposals this quarter. So a lot of units, 64,000, continuing to trend up. And then vacancy rates up to 1.8% versus hovering around 1% over the past 6 to 8 quarters. So it's obviously for obvious reasons. So now I'll hand it over to Ian, who is going to talk about multifamily overall in terms of the vertical.
So Steve, tremendous. Thank you so much for that. I appreciate it. So just to race through this, in terms of multifamily, housing truly is core. Everybody needs a place to live. We find that there still are risk adverse or financially unqualified, and that qualification level becomes seemingly tougher by the year, even semi-annually. So some will seek the safety and reduce commitment by going ahead and renting instead of owning. In terms of demand for rental housing, we're going to talk about immigration in a moment. The bottom line is that Canada is more attractive today by all measures year over year due to politics, the pandemic, et cetera, et cetera. Immigration now for sure has halted, but we think that when the doors reopen, not only will we get back to the levels that we were at, but in fact there will be an overage or flooding that will come into the country, at least from an application perspective. In terms of development limitations, some of those limitations are associated with timing to achieve entitlements, a lack of the skilled labor force. We know that everybody, all of our young ones or new graduates are trying to get into either finance or real estate or technology. So there's a huge opportunity there for someone to come along and take advantage of a limited skilled labor force. And then of course, NIMBYism comes into play as well. In terms of financial certainty, if you look at the bear and bull comparisons of the stock market, be it through CNN or Bank of America or Morgan Stanley, what have you, you'll see that the bears still outweigh the bulls the bears are at about 60 some odd percent, 65%. So call it 2/3 bear, 1/3 bull. And so all of that is a concern around having financial certainty and having a nest egg for the future. In terms of delays in traditional household evolution, and what we mean by this is that the natural progression of when you would move out of the parental environment and go into your own home or start creating your own home with your own family, we see that there's going to be and believe that there'll continue to be an extended stay in the parental home due to job uncertainty. And even if you have a job now, as so many people, so many of us, and we try not to listen to the noise of the media, and we get scared and freaked out by that. So bottom line is that will keep some people home longer than normal. That will cause them to be married at a later date, kids at a later date, and quite frankly, we're hearing more about sharing households. So I guess, Steve, by way of this presentation, we're coining a new phrase or a new item called the multifamily, meaning we're putting a number of families in one house and doubling up to save a buck. Stevie, can we move on? Oh, sorry, Steve.
Yeah.
Let's stay there for one moment real quick. I just want to read a few statistics. I'll rip these off. The average sale price per suite was $276,000. These are year-to-date statistics, year over year, up from about $273,000. Average cap rates now are around 3.35%, down from 3.5%. Investment volume year to date is $1.3 billion, pretty similar to what it was in Q3 2019. Large portfolio sales have certainly helped maintain levels of investment, and Starlight and Timber Creek have represented over 50% of that year-to-date activity. We're going to see that certainly the condo rentals are more volatile than PBR, and I don't think we explained that acronym for some of you that don't know, but it's purpose-built rental. It's an acronym that replaced the word apartments a little while ago. Stevie, can we move on, please, to receivership and bankruptcies? Thank you. So I'm just going to read right off the slide here. So we thought that there would be an onslaught of insolvency, bankruptcy, and restructuring, at least by Q3, maybe Q4 of 2020. Didn't materialize. We think that a lot of that is because of stimulus and sort of kicking the inevitable can down the road. We're not here to be the Grim Reaper or suggest that there's going to be fire and brimstone, but we do believe that that financial institutions are preparing for defaults coming up, and we expect activity to evolve throughout 2021. I know I jumped over a bullet in the middle, but we call them new or newer developers who have had to borrow from non-traditional lending institutions like the banks. So they've had to go to alternative lenders, and often that comes at a higher interest rate or cost of capital, and many of them didn't factor in an additional 12-month carry due to a pandemic. No one really could have. So it'll be interesting to see what comes out of that, be they restructurings or all-out insolvencies. And we are very busy on the insolvency side already. Steve? I think we're going to new office supply. Yay, okay. So new office supply, effectively, the messaging here is that there was 10 million square feet of office development in the last 3 years and currently progressing. 80% of it was pre-leased. So we acknowledge, by the way, that the slide that you're looking at is pretty difficult to read the fine print. Even with my glasses, I can't read it, but we'll certainly get this out to you after the presentation is complete so that you can zoom in on that and actually figure out which ones these are. So the slide you're looking at these are for announced projects between now and 2026. You'll see that across the top of the buildings in the skyline. The blue represents buildings that are fully leased. Red represents available space to be leased. And this does not represent the sublease situation currently going on, which I'll address momentarily. And in fact, I'll address it now. Google, Facebook, Shopify, and Twitter have all made announcements that they intend to have employees work from home even after the restrictions begin to loosen. So these tenants represent millions of square feet in the market. We think that there will be a bit of an adjustment as that space is eaten up. And we think now that there's roughly 1.8 million square feet of new sublease space that's been listed since 2020. So, and 64% of that, by the way, in the Greater Toronto Area market is represented in downtown opportunities versus the suburbs. There's been very little absorption occurring, which should place downward pressure on rental rates, over the next several quarters. And you can see that here on this quick slide on absorption, you'll see on the far right-hand side, Q2 was negative net absorption. So I think it's a relatively simple and self-explanatory chart that you're looking at now. Again, the years on the bottom and the quarters, if you can't read that perfectly, we're going to get you this presentation so that you can go through it on your own. And again, happy to answer any questions. Steve, off to immigration, please. So this is a slide we have shared with you in the past, in our past TURA talks. This really, I won't get into the granularity of it. You can read that for yourself. But certainly it talks about targets throughout the current and coming years and where we are in actual fact. So year over year, March immigration was down 30%, and April immigration was down 80%. So just over 4,100 were processed and admitted as compared to roughly 27,000 in April 2019. Something of interest to take into consideration is digital work permits. So when you're working remotely, when skilled immigrants are working remotely, they cannot necessarily receive a work permit, but they can receive a social insurance number. They can receive a work permit, but they can't receive a social insurance number unless they enter the country. And they also can't be paid without a SIN number. So technology can offer a solution to this impasse in that a security-proof digital work permit, or SIN, could be assigned remotely, allowing these virtual immigrants to start working remotely with their Canadian employers while they wait for the entry ban to be lifted. Something of note. So, and on this, before we go past immigration, again, I think I shared this earlier, that we believe that immigration will, yes, the doors are shut right now for obvious reasons, but we believe when the doors open back up, not only will we get to those original levels, but we're actually going to get above and beyond those. So sure, we may be in a tough time right now, as Steve explained, relative to rental. There's a lot of Airbnbs that condos downtown that have been bought up by people that are quite frankly, barely covering their costs relative to the rent that's coming in. Now that rent is gone, and there's been a bit of a concern / panic in putting those on the market. So do we have to chew through some inventory? Yes. Is it going to take a little time? Yes. Will the market come back? Absolutely, it will come back. So depending on where your development is, if you're in the development stage still in the construction stage, depending on where your development is and when delivery is, you may not even see a hiccup along the way. Steve, where are we going? Jobs? Jobs. Okay. So let's go to the tech market. So as you look over this chart, by the way, all of these numbers, these are average tech worker salaries. All of these have been converted to US dollars, just to make it simple for everybody. So if you think about this, why are so many coming to Toronto? There's a lot of reasons to be here for sure. I was born and raised here. I'm a pro-Toronto guy all day long. Having said that, we noticed that there was something perhaps a little more relevant for why this has taken place and will continue to take place. During the Obama administration, getting into the US was difficult. You could do it, but it was a little tougher. With the current administration, it's near impossible, and has been for years, to get in by way of an H-1B visa. So the US has effectively, without even knowing it, run out of people that are smart and or qualified enough to be employed in many of the top jobs within tech. So the result has been that the US has inadvertently said to the world, hey, tell you what, we'll meet you in Toronto. So that is a big part of the reason why we are seeing it. We have seen in the past, are continuing to, and certainly will see in the future, a surge in our population within the Greater Toronto area and Canada as a whole. Steve, let's move on. Construction, thank you. So I'll be very brief on this. I'll let your eyes do the reading on it. The bottom line is that this is we want to explain the massive hit to construction jobs during this pandemic that we've been through. If I hear the word COVID again, I don't know if I could handle it. So you'll see that April, we lost about 300,000 jobs. May, June, and July had upticks rather, but net, we're still down 125,000 lost jobs to be recovered. So we're getting there, but we're still down from where we were. And Steve, if you will, I'd like you to go to the next one. Take this over before I wrap it up, please.
Sure. So what does this all mean? So again, what are the opportunities in the market as we see them? Obviously, we spent a lot of time on it. I talked very long about legislative changes. So these legislative changes are leading to great opportunities in the market. And so if you look at 2022 as the MCR for the City of Toronto, the Municipal Comprehensive Review, there are a lot of opportunities around major transit station areas, which are going to be predicated on change of use. So a lot of employment lands around future GO expansion stops or Ontario Line and other transportation lines. You're going to have to make some bets, but the bets could be a huge payoff in terms of converting of those lands if a station is nearby. Provincially significant employment zones, although previously it was anticipated that those were untouchable employment zones. Now with the updated legislation, those can be converted if there's transit nearby. Low rise has seen quite an uptick again, and we're already seeing that in terms of, as I mentioned earlier, in terms of land acquisitions. In terms of interest rates now to purchase, current mortgage rates are around 1.7%, and the stress test is around 3.14%. So we're going to continue to see the low-rise market gain steam, which is in stark contrast to the current condo market. So paying attention to these policies and making bets in the appropriate area, we think there's massive opportunity. Condo market outlook. Currently and over the next 6 to 12 months for resale and leasing, there's a glut of inventory on the market and it continues to rise. But, I was talking about this the other day with a friend of mine, and if you could put together a fund to go out into a building, pick ICE condominiums or the old Four Seasons where those permitted Airbnb use previously, and there's 80 to 100 units available there. If you could go in and buy 20 of those units at a discount, wait 5 years, you'll do very well. So this current glut of inventory is related to both Airbnb and the current economic situation. We think it's very short term, which we think creates a lot of opportunity. And what will drive that absorption? Well, Ian mentioned it. All the immigration coming back, the continued focus of Toronto as a tech hub. The CEO of Shopify, Tobias Lutke, was interviewed on a podcast recently, and he said, "Why did you choose to come to Toronto?" He said, "Canada is US, the US for Europeans." So we're going to continue to see those type of tech entrepreneurs come to Canada because it's easier to come in. So the absorption of the current condo glut will be short-lived. Another thing to consider is government tax increases in terms of market next steps. So there's been long rumored increases to the capital gains inclusion rate. Never let a good crisis go to waste. And we think that the government may not let this good opportunity go to waste in terms of recovering all the economic stimulus that has been put into the market. So we think that if there is any opportunity in time to do it, at least from what I've seen in my lifetime, it's now. So a lot of property owners, although they hear this buzz in the market, it's something that could be quickly announced and could, for example, put a glut of commercial properties on the market. So that creates opportunities for buyers. A lot of developers on this call. If you're working on existing transactions, that's something that should be in the back of vendors' mind, or at least will be in the coming months. Obviously, income tax increases as a result of this overall in the general economy is not good. And then what else? What other tax increases or economic recovery costs will there be from this pandemic? It's still to be determined. It's something that should be factored in. And so return to normal. This is something that not everyone knows, or most people don't know. A lot of rumors around a vaccine being announced later this year, but distribution of this vaccine, the earliest that we're hearing is Q3 to Q4 of 2021. So that's if the vaccine actually works. And if you need to get 2 shots of this vaccine, you're going to have to wait in between the vaccine shots, months. So this could be a 2022 back to normal. So that's, again, creates opportunity. When others are fearful, be greedy, and when others are greedy, be fearful. So I think there's opportunities with all the uncertainty. Immigration return, as Ian had mentioned, that's a return to normal in the next 24 months. Geopolitical influences, just on a global level, we say this all the time. It's actually, me saying it. I'm sick of hearing it, but it's true. Canada will continue to be stronger out of this, and Toronto will be the main beneficiary of it. Tech demand strength can continue, as Ian had mentioned, and a return to urban. So,
Stevie, let's just drop to we're on the last minute here. So maybe we just go to the last slide.
Sure.
So where are we going? Very quickly, we can call this whatever we like, but the bottom line is that we can help out from a joint venture structuring perspective. So we're being asked to go ahead and help out real estate owners find developers and capital. We're asked by developers to find owners that want to partner and capital, and we're asked by capital and or the capital providers to go out and find the owners and development partners. So if you find yourself in any one of these or wanted some advice on it, this is what we're doing with our time on a regular basis. And Steve, where are we going in the future? Generally, to hell in a handbasket. So we don't actually believe that. If you read Uncle Jerry's thoughts on New York a while back, we think the same thing here. We think that that the world will come back into the urban centers. We believe that we are going to come back stronger than ever before. This, while it may not be fun, this is a controlled burn of a forest, and it'll unfortunately it's gonna affect some of the weak businesses, et cetera. But we will be back. We will be strong in an urban center, and we're looking forward to that. If there's anything we can do to help you out, any of you, let us know. We are happy to do so. Hopefully, we've answered your questions. We're grateful for your time, and we certainly appreciate the collaboration. So on behalf of Sylvia, Tina, Steve, and myself, thank you, and be safe.